The Stock of the Day is brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended trading hours on key US shares and competitive spreads, all on an award-winning platform. Get started at IG.com.
Now, as it turns out, the Stock of the Day is actually one of the biggest on the local index. It is Wesfarmers. This after announced plans to sell its industrial gas supply arm, Coregas, to a Japanese multinational for $770 million. Coregas, part of Wesfarmers' industrial division, one of Australia's largest manufacturers and suppliers of industrial gases, distributes it to medical, specialty gases in cylinders and the like, bulk gas for users across Australia and New Zealand. And it expects to report a pre-tax profit on the sale of around $230 to $260 million. Meanwhile, earnings for the company were growing slower than the company's share price, essentially, with the price to earnings ratio climbing to around 32 times. So, given what we've seen with Wesfarmers, and as you can see there, shares down about 2.5% today, how do experts see the conglomerate and one of the largest? Daniel, let's start with you.
Yeah, it's an interesting announcement today, Andrew. Obviously, they're kind of talking about freeze up for capital management initiatives, and effectively, we know Wesfarmers has a history of trading assets. Coregas has been a business they've owned for a long, long time, and really the sale price and the impact to group EBIT, I wouldn't say it's very material, but I'm just interested to see, what the group is planning going forward. We know they love to engage in M&A for growth, and given, like you said, the script or the share price and the equity value as Wesfarmers has accelerated significantly ahead of its earnings, will they use that as a potential funding source for an acquisition next year, and potentially using this to maybe de-gear the balance sheet as well a little bit? So I just think from a strategy point of view, I'm interested to see how this plays out. The key thing for us is, high quality business. We have it in our growth and income portfolios, but it's just very difficult to see this level of growth in Wesfarmers continue, given that the top line, is only estimated to grow at around 3 to 5% going forward. So it does give you that defensiveness due to its conglomerate nature, revenue diversified to different areas. If the market was to sell off, like I mentioned, this would be one of the quality defensive businesses I'd look to increase exposure to at the right price. But, at the moment, I'm probably leaning towards a bit of a trim, just given that, almost record defying valuation multiple at the moment, Andrew. Interested very much so to see from a corporate M&A perspective, though, will they use that to their advantage?
What sort of price would you consider re-entering then, Daniel?
Oh, look, it does depend on whether or not there's an earnings step change at the moment. But look, I think at the moment, 20, 25, even to 30% fall, would bring it back into a more, I guess, normalized valuation purely from a multiple perspective. So we can see how much the stock prices, arguably can have to fall. Analysts are kind of suggesting that CBA looks 50% overvalued, just as an example. So, I think it's probably a bit steeper than what most people would expect.
Yeah, but as we all know, like for instance, CBA, the market just ignores that, doesn't it? Continues
exactly,
grinding
for the time
higher.
being.
Yeah,
exactly.
Luke, how are you seeing it?
I agree with most of that, Andrew. I mean, the rally over the last year, stock's up 30-odd%. As you rightly pointed out, it's not supported by earnings growth. It's a business where you look at the major drivers of segments, Bunnings, Kmart, Officeworks, some industrial assets. They are good assets, and there's a reason why the market will pay a bit of a premium to the average market multiple for Wesfarmers. But you're never going to get high growth from this business. It needs to do things like this, where it's recycling assets and unlocking value. Look, it's a nice cash injection, $770 million. I did go back and have a look. They paid $500 million back in 2007. So the compound return, not fantastic, only about 2.5%, something like that. But nonetheless, you sit here today, it's a non-core asset. $770 million is plenty of dry powder for Wesfarmers to put to work. Now, I agree with Daniel. It depends what they do with that. Their last big purchase was, lithium assets a few years ago, which, the timing of that has ended up being quite poor. And they've come out and said that they're uneconomical at the current lithium prices. prices, like a lot of producers. That's not just Wesfarmers. And so it depends, when we talk about Wesfarmers today and can they get that step change in earnings and what does that do for the valuation, it depends on what they buy and where they buy it. I think their greatest success has been in, those businesses we've rattled off for, those industrial style business, retail businesses. Obviously the history in commodities as well gives them, some expertise to go into that space. But wait and see what they do. I think for now that valuation, it's very steep. 32 times earnings, and they're growing at 2-3% a year. Nice and steady, but a bit too rich for me. At best, I'll call it a hold. But I probably agree with Daniel. If it's one that's crept up to a high weighting in someone's portfolio, I think this is one you could look to trim and maybe either redeploy back into Wesfarmers if it continues to pull back, or look for other interesting opportunities in the market.
Okay, there we go. Similar view, quality stock, but it is expensive at this point, so maybe consider trimming. That is our stock of the day.
The stock of the day was brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. Get started at ig.com.